Good afternoon to everyone, and thank you for choosing to be here and for choosing to spend your afternoon here with us. So, for those who don't know, I'm Patricia Rogan-Faber, and I do a podcast show to help people maximise property values, and it's called Maximising Property Values. It's on all the popular podcast platforms, so you can find it on Apple, on Spotify, on Google, on Audible, all of those. And it's a monologue, but I've now added a guest series, so there'll be at least two of us talking. And this is one of them. And I'm doing it via Clubhouse. So that's why I call it my Clubhouse guest series. And my guest today is Rosita MacGowan. Now, we are going to look into Rosita's life as much as we can. So, Rosita, do bear with me. So, now, what I'm going to do actually, before I go into any of that, is I'm going to post Rosita's link. So the link that's up there at the moment, if you tap on that, that will get you to the podcast. So if you want to listen to this, you just go there and subscribe to it on your favorite channel. And you will then be able to get anything that comes out. And this here is a link to Rosita's website. So again, click on that to find out a bit more about Rosita. But before you do that, let's just find out who is Rosita. Now, in October 2020, somebody wrote this about Rosita. Let me just read it out. Rosita is a highly... Let me start again. Rosita is highly knowledgeable in property tax and law and is trustworthy, approachable, and professional. She is committed and focused on my brand and marketing mastermind. Okay, I've given it away. And is quite the entrepreneur too, as well as being a thoroughly lovely person. So, this was something that Rob Moore wrote about Rosita in 2020. Yesterday, when I posted a story about this room happening today, somebody commented, "She's amazing." So I went back and I said, "Oh, you know Rosita, do you? How do you know Rosita?" And it was, "No, I don't actually know her, but I've listened to her and she is simply amazing." So I'm not going to tell you who that was because obviously they don't know you. And that comment was to me, Rosita, but these are the things that people are saying about you. So, Rosita, welcome to Maximising Property Values. But before we go into the nitty gritty of today and this room and this podcast, I would like you to tell us, so that we get to know you even better, the best and the worst thing that's ever happened to you. So that's two things. The best thing that's ever happened to you so far and the worst thing that's ever happened to you so far.
Hi, Patricia. Wow, what an introduction. I came feeling really scared, and then you picked me up, so I'm feeling much better now. Thank you. So the best and the worst thing that happened to me. There are quite few of those, but I probably will pick the same event that actually was the worst thing and the best thing for me. It was the breakdown of my marriage. Oh, I'm just trying even to think now how many years ago that was. I don't know, 8 maybe, something like that. It completely broke me as a person, who I was and how I saw the world, and my whole world shattered in front of me. And the reason it was so bad for me is because, unfortunately didn't have the best upbringing, and family is something that I always longed for. And when I, got married and we had 2 children, we married for life. That's how I saw it, and that's how we both saw it. But unfortunately, things didn't quite work out. We weren't very well matched, as it turns out. So So that was my, a dream that I had since the age of probably 5, to have my own family. And all of a sudden, that, the rug was pulled and everything shattered. So I've built myself, on that. And then all of a sudden, I no longer had it. So that was the worst thing. But the best thing that came out of that is sort of, my whole world, my whole life transformed inside and out. Um, I learned how to feel, that family within, and how to create our family, just 3 of us. I became, even though I was always, independent, but now I just became so fiercely independent, in every way. I'm so happy, with pretty much, like, if there is anything you ask me, I'm just so happy with my lot. Everything that there is in my life, however, no, not perfect it is, but I'm just really, really solid happy. And not like, joyous, like, or ecstatic. I'm just so content. And so everything sort of fell into place. It's almost like in a slow motion, the bombs gone off and the floorboards were ripped and the roof came off. And then everything slowly just came together and fell into the right places. And the beautiful, harmonious, warm house was built. That is my home. And that's probably, and that built me as a professional, that built me as a mother, that built me as a friend, in every shape, or form. So that was my best and worst moment, Patricia.
Wow. Do you know, Rosita, you that that was so passionate. Thank you very, very much for sharing that with us. Do you know, I'm so glad that you agreed to come on to this. And I am so glad with the people that I've had on this show, because every single person is my kind of person,
Mm,
a truthful person, an
mm,
honest person, somebody who embraces who they are.
mm,
And that, oh no, thank you, I am delighted, you know. And the more I get to know my guests, the more humble I feel, and the more blessed, actually, that I do actually know you guys. And not so, and these questions, even though they started as like a tongue-in-cheek type of thing, I am benefiting so much from them, because I really am getting to know the person behind the name, behind the picture, behind that professional. So great stuff. Thank you, thank you, thank you, thank you so much. Now, I know that you don't bill yourself as a property person, and because you are a tax expert, I thought we would make this all about tax and taxes. So, can you just share with us a few mistakes that property professionals make? Because I would love, for me, the way that I personally learn the best and the most is from my own mistakes and from other people's mistakes. So I'm hoping that other people might kind of like learn the same way that I do. And if you share some of those mistakes with us, there'll be things that we will say to ourselves, I'm not going to make that mistake. And that will just help us build our businesses better and faster. So if you don't mind sharing a few mistakes that you know that property professionals make, then hopefully that will help all of us. Thanks,
thank
Rosita.
you. Thank you, Patricia. Yes, I mean, as you were talking, I was just nodding away and, getting a tear in my eye because, yes, it's exactly that. It's just so lovely to connect with, people, like-minded people, and we connect on those same values. Now, with regards to, the mistakes that property investors make, I will start with the bigger picture, and then perhaps we can delve in a little bit deeper with that. So the number one thing is we don't know what we don't know. And the biggest quandary for any property investor is people when they starting out on their property journey. Again, we don't know what we don't know, so they don't know what they don't know, and often they think, well, I actually don't need tax advice right now, and because it's quite expensive. Obviously, all professionals, as you know, Patricia, our fees are reasonably higher than standard accountant or a bookkeeper, and they often would compare that. You think, oh well, actually that's quite expensive. I don't really need this advice right now. When I need it later on, then I will look into it. What happens is later on is when the mistake is made, or advice is not taken, or they've not taken advantage of something that they could have, then they look back and they think, I should have really taken advice there and then. I should have. So it's often at the beginning, either the finances aren't there, and so the decisions are made purely based on finances. But you sort of end up paying for it in the end, much more, because you've not taken the right steps. So, for example, number one, and it's a very, very simple one. Not charging interest on director's loan account. So we're talking here about individuals starting out and opening up a limited company. So this is corporate structure. So you bought properties in a limited company, and most of the time you would have invested your own money there. Now, if you haven't charged interest on director's loan there and then, you can't go back and charge it again. So currently, it's just popping into my mind. I spoke to a lady about a week or two ago, and this is one thing that she regrets greatly, because she has invested a substantial amount of money into her limited company, and she wasn't aware of this, and basically she wasn't able to take advantage of that, because something like, for example, if we take, let's say, the salary, if the salary is paid to a director, the company doesn't have to pay out that salary. That salary can go and sit on director's loan account, and the director, whenever in the future, if they want to take that money out, they can. And that will be already tax free, because let's say, for argument's sake, you put, that's 8,840 every year in through the books, and you've taken advantage of that tax-free allowance of every year, whatever it is. Currently is 12,500, and next year is going to be 12,570. So that money, was put through the books. You didn't pay any tax on it, but that money accumulates. So if you start your journey, let's say, for the first 5 years, you've not taken anything out. So if you put that 8,840 for 5 years, that's going to be £44,200 that is available for you to take out tax-free when you are ready, because that will be sitting on your director's loan account. Now, of course, there are other implications if you're looking for investors, and that will sit as a liability on the account. That's so everything's got to be looked at in a bigger as a bigger picture. But with the director's interest on the director's loan account, the money that company owes you, if you are, the money that you invested, if you charge interest on that, that interest has got to be paid within that financial year. So that's something that cannot be put and onto director's loan account and sit there. It has to be paid out that particular year. So fair enough, if you didn't have enough cash flow to take it out, that is fine. But in this instance, this lady, she feels really, really let down, because she didn't know that she could have done that, and this would have reduced her tax liability. Not only that, it would have reduced the company's tax liability. So, because that interest that company pays is a tax deductible expense. So it's a really, really good way of taking the money out.
So, Rosita,
Mm,
just a couple of things here. So,
mm,
the tax-free amount that you're talking about,
mm.
that is if the director isn't earning money anywhere else,
Yes,
and this is their first amount of
yes,
taxable income. Okay,
yes.
cool. And secondly, now with this interest, now
Mm-hmm.
the interest, isn't it? Can you just tell us? Because okay, so I don't charge interest on my director's loan account, and I took the view because I like an easy life, and I understood, or I understand that when you charge interest on those loans, you need to return, I think it's a quarterly
Yeah.
report to HMRC
Mm-hmm.
CT, is it
61.
61?
Mm-hmm.
Can you just tell us about that? And am I actually an idiot for thinking that, do you know, I'd rather not do these CT61s, and I'll forego the interest. But having said, I have an agreement. I usually have an agreement between myself and the company,
Mm-hmm.
which allows the company not to pay me interest. So I don't charge separate interest. I just say,
Mm-hmm.
if that money is costing me whatever, I can't remember the wording that I use, then what the company is doing is it's literally just indemnifying me. So in a way, it does pay interest, but it's not paying me interest. It's literally
Mm-hmm.
just paying the amounts back. So tell me, am I wrong? Am I right?
There isn't right and wrong. So yes, there is an administration there involved, but then again, it will depend on the amounts. So if the amounts are reasonably small, so you've got to weigh this up and think, well, actually, who is going to be doing that CT61? Can my bookkeeper do it? Is that something that can be, so like you said, it's got to be done quarterly. So in just to give an overview, CT61, it has got to be completed by the limited company if that company is paying interest to an individual. If the company is paying interest to another company, another corporate body, it doesn't have to do that. Now, if it's paying to an individual, then the regulations are, the requirement is that the company is to withhold 20%, and that 20% the company will pay over to HMRC. So you will receive that interest less, 20% less, and then you will reclaim that 20% through your tax return. If obviously, if there is tax, if there is no tax to pay, if there is tax to pay, then obviously that will be balanced out, and that's how it goes. So, for example, if you think about it, let's say for a higher rate taxpayer, you would be thinking, well, why do I want to be taking out the interest and pay 40% on it? Because that's what you will have to pay. There's only £500 a year for a higher rate taxpayer that can be paid to you tax free. Anything over that will be taxed at 40%. But so that's if we're looking just from the cash perspective. However, if you look cash in hand, but if you are, the if the company is your company, if you don't have other, shareholders, what have you, then you've got to look at the picture as you and the company. You've got to adapt those, you can adapt those savings, and so you will say, okay, if my company is paying me, £1,000 of interest, that £1,000 will be tax deductible. So I'm going to be saving 19% tax on that. When the company pays me that interest and I'm going to be paying 40%, yes, I'm paying 40%, but I've already saved 19% within a company. So you see what I'm saying? Overall, it's a really tax efficient way of taking the money out. So it will depend on the figures. If it's only, a few £100, you would be thinking, well, if I'm only getting a few £100 and then I've got to pay that, my accountant or bookkeeper to do the CT61, and then transfer all those payments and faff with that, then maybe it's not really worth it. But if there is substantial, amounts involved, I think somebody we were having this discussion with at another point is, for example, if you are needing bridging finance, let's say there is no other type of lending available for you. And the only type of financing that your company could get would be bridging finance. Now we know that could be really, really expensive. And I see that all the time with completion statements from my clients. So then you think, well, if I can prove that the only finance that my company can get is bridging finance, and if I can provide that finance to my company, then I could potentially charge similar interest on that lending. So then it becomes, well, actually, that could be potentially a very, very good return. And then in that instance, it might be worth taking this path. So yeah, I don't think you're being silly, or I can't remember what the word you used, Patricia. But it all depends on the figures.
Wow. Great stuff there. So, let's look at your example again. So, £1,000. So, if someone was going to charge their company £1,000 and they're a higher rate taxpayer, when the company pays the interest to them, the company has to deduct 20%. So that would be what, £200? So the company will pay the director £800, and it will pay £200 to HMRC. Then, when the director is looking at their tax return at the end of January, well, up until the end of January for that period, they then have to account for what, 40%? 20% has already been withheld. So they have to equalise that, don't they, by paying another 200 to HMRC. So they are left with £600. So that £600 that they've got, so that £600 has then cost them £400 in tax.
In theory. But
Okay,
then you've got to use the £190 that company saved on the tax.
Okay, so the 190 that the company's not paid, so that then reduces the total tax cost to 210. Okay, I'm not good with figures, so do bear with me. I'm
No,
bound to
that's
make a
okay.
mistake at some
No, it's
point.
okay. I'm going with you, and I'm using a calculator to
Okay,
just
great
as
stuff.
well. Yeah.
Okay, now, can you tell us, Rosita, if this is one option to do it, and the other option is to actually take a dividend in the company, what would the figures be like if that person thought, okay, I won't do interest, say they've got the opportunity to do it because they're just starting out, like you explained, and they say, actually, I maybe won't do the interest, I'll do the dividends. Can you just tell us how £1,000 of dividends will, oh, actually, let's say this is the second company that's going to be paying them dividends, because the tax-free dividends you can only get from one company. So let's not complicate it. Let's assume that this has to be taxable. How would that work on £1,000?
So if we work with the first example that we set, and we take into account that £190 that company saved, yeah. So we in total we're saying we paid 210 pounds in tax.
Yeah.
So that's 21% tax in total. So for a higher rate taxpayer, I think that's great, right?
Yeah.
Now, if we are to take that £1,000 as a higher rate taxpayer, you would be paying 32.5% tax on that. So you will have overall less cash in hand.
For the same amount. Sorry, I didn't even mute myself back. I was
Yeah, that's all right.
excited to hear your answer. Okay,
So
so
so let's have a look
dividends.
at this. Hold on, I'm just going to put this into the figures. Hold on, 21. So with the first interest example, you will have as you know, cash in the pocket, or not cash in the pocket, overall figure will be 790, and with taking the dividend out, it will be 675. So you are looking at £115 difference, or in other words, 11% extra from the total amount. So I think
Wow.
that's a good percentage.
It's an amazing percentage. It's just so much more. So clearly then, based on these two examples, it's better to charge interest and to take the money out as interest rather than as dividends. Now, with how much roughly, not you, but generally in the industry, how much would an accountant cost? So not a tax advisor, but just an accountant. How much would they charge to prepare these CT61s 4 times a year? Because we need to compare, like for like. I'm assuming. So I'm trying to drill down into these numbers a bit more.
So, probably all in all, with completing the paperwork, start to finish, making a payment, communicating, sending all through, it probably will take about an hour's work, right? Let's just overestimate. It probably wouldn't take that much, but you know what it's like, Patricia. You as a solicitor, you know that there are always more steps involved than just the completion of the actual form. So let's assume these are 4 hours of work, a year. So 4 hours of work, you're just looking at how much your accountant will be charging you. And a lot of good bookkeepers will be able to do that. So the good bookkeeper, we're talking about 35 pounds an hour. So, that's what, let's say 4 hours, £35 an hour, £140 a year. That's for you to pay a bookkeeper to do that. And most accountancy firms will have somebody else who would be able to do that kind of work for for a lower fee, because we always we always delegate as much as we possibly can, and that's what I always do. I delegate as much as I possibly can to save my clients money, and that's why my fees are much lower, because of that, simply.
Right. Okay. So I guess it's a question of preference. But this is something which people, honestly, if you are in that position, you want to literally be linking up with Rosita so that she can go through this with you, so that you can make sure that you are not losing money. You are not throwing money away. And like with most people, what she's saying is look at the numbers, you know, put pen to paper, drill down, find out, what is actually going to cost you more or what is going to put more money in your pocket. So thank you very much for Rosita. So that's point number one, which I have labelled, don't be penny wise and pound foolish. Spend a little bit of money, get some good advice and save more. So yeah, okay, so that's point number one. Okay, carry on, please.
So we're still on the mistakes.
Yep.
So that's one. So the next one is already I've mentioned is that beginning to take salary. So that would not apply to everybody. If you've got employment elsewhere or you are taking salary from your other companies, you've only got that £12,500 of tax-free allowance. So again, working that out and making sure that you're maximizing it. And if you're not taking a salary anywhere else, please make sure you do account for that in your limited company and put it there, because the more the more you have in your director's loan account, the more you can take out tax free from your company eventually. Because the idea is obviously the number one question, as you know, Patricia, it's always, do I buy in my own name or do I buy in a limited company name? And there's, there isn't one answer for everybody. The circumstances will be different, but if very often we will say, if you don't need to take money out from your limited company, if you don't need that money to live on that your limited company will be producing, then have a limited company and start with an exit plan in mind. How are you going to eventually get the money out from that company? What is it that you have in mind? Will that be left to your children, to other family members? Do you need to start planning and inheritance tax planning? Obviously, I've said this many times before, that's not something I specialize in, but I do work with somebody who does. So that's number one. Will you be thinking of selling the business? Again, if you think of selling it on, perhaps it is a good way of thinking how you're going to run that business so that it is attractive to be sold eventually, so it's attractive for the buyers. And that's something that we also work with a number of clients on. I have in my network, I have a couple of really good advisors, and they are, also they are chartered accountants who have moved on to these areas of expertise, and they specifically specialize in finding buyers for businesses and helping small businesses to build up. So one is helping small businesses and small and medium, and the other one is only dealing with really large companies. And then when you're starting with that in mind, how am I going to exit? How am I going to benefit? Then you realize the value of the director's loan account, and when will you be, because at the end, when the company is sold, you will be able to take that money that will sit as a liability on the balance sheet of a company, and you will be able to take that out tax free. So that's the salary part that a lot of property investors don't take advantage of.
Oh,
uh
Rosita, sorry.
yeah.
So my brain is whirling around right now. Um, so, um, so when you say they can take that out, will that also apply to us property people, that HMRC doesn't consider us to be in business, as well as people who are in business, who they accept are in business? Does it apply to us equally?
Well, absolutely, because if you have a company, you are a shareholder, you are a director, and in this instance that we are discussing, you would be an employee, so you would be on payroll. You're working for your company. You are employed by your company. So regardless, with regards to whether, obviously, the if we're talking of standard, buy to lets, and what you're referring to as investment company, opposed to trading company from HMRC's perspective, then that really makes it depends which act we're looking at, and depends what are we trying to achieve. So when it comes to your taxing your income, it will be taxed, property income, it will be taxed exactly the same. But then when we're looking at reliefs, availability of reliefs, then that's when it will differ. But anybody employed within a company, for somebody who's actually working, and you would, as a director, you would be, you can, that's just how it goes. We employ people to do work for us, and company is allowed to employ you and pay you a salary for the work that you do, and you are legally entitled to maximize tax reliefs available for you to minimize your tax liability. So here we're not talking about the tax avoidance, we're not talking about dodgy ways of going about it. We are here looking at what's available, and we're trying to make sure that we apply that to you, because like I said, you are working for your business, so therefore you are entitled to pay yourself a salary if that suits you. So you're not just an investor who's a shareholder who gets paid a dividend. You're much more than that. And
Oh, okay. Oh, okay. So maybe I'm getting myself confused. So the point that my brain latched onto was, if so you agree with the company that the company is going to pay you, let's say, £10,000 a year, and that agreement is in place for 5 years, but you don't take any of the money. So your director's loan account is £50,000 more than it would otherwise have been. And then you sell the company. And then I thought you said you could then take everything in the director's loan account tax free. So that's the bit that I was looking at. So you get the £50,000 tax free, and you don't have to pay any tax on it whatsoever. Oh, okay.
because you've already paid tax on an annual basis. So you see, because do you see my point?
So when the amount goes into your director's loan account, you're actually paying tax on it, even though you're not getting it.
So that let's say that £10,000 would have been put through payroll within your company, yeah. And that £10,000, instead of company paying you cash, the company put that into your director's loan account and made that available to you to be paid whenever the company is ready or whenever you need cash. So
Ah,
you as a taxpayer have taken advantage of that tax-free allowance that everybody else does, and instead of paying yourself cash, then you are keeping that money there because you perhaps saying, well, I don't need cash today. You perhaps have other properties in your personal name, and you're receiving cash that way. Or perhaps I don't know, you're living off dividends, and it depends on your personal circumstances. But obviously we must not forget that that salary is going to impact, because that only £12,500 is what you've touched upon earlier. That £12,500 is available as a tax-free allowance, towards all of your earnings. So dividends will be, taxed separately to start with, but eventually, if all you're getting is dividends, so you'll get your £2,000 tax-free dividends. But then if all you're getting is dividends, then that £12,500 will be applied towards those dividends. So you sort of got different brackets of income that is sort of pooled together, but then they tax separately, but then they tax together. So it sounds very confusing, but if you put that on a paper, it's actually it's quite transparent. And if I confused you in any way, Patricia,
oh
please
gosh,
ask.
no, 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 no. I'm literally just, as you know, well, as I hope you know, I'm hopeless with figures. So this amount, so my £10,000 salary, I'm
Mhm.
paying tax on it. So whether or not I sell my company, I can take that money out, can't I?
Mhm.
Because I've already paid
Correct.
tax on it.
Oh, I'm so sorry. Let me just put that phone. I didn't expect that to be here. Yes, that is correct
Okay,
because you've
cool.
accounted for tax and
Already
you
on it
can, yeah,
already. Okay,
yeah.
cool. Great. Wonderful. Okay, so that is number two, salary. Do you have any other mistakes that we tend to make?
Another one. So another one is the when when people incorporate their limited companies, one step that is often missed is the classes of shares. Often we would put our family members as shareholders, and we will take the same classes of shares. So here we're talking family companies. Of course, it will be very different with if we're talking at SPVs with as a joint ventures. So if you've got, let's say, family company, and let's say, Patricia, you and I were, we are family, and we've got a company, and you're thinking, well, I'll put you as a you let's say you will put me as a shareholder, and then we want to take money out later on as pay ourselves dividends. Now, if you have the same classes of shares, you are very limited because you can only declare dividend the same amount per share. So that's where the limitation comes in. Whereas if you have different classes of shares, then you will be able to take out different amounts to suit you. So let's say if it was a husband and wife, that's a standard setup. Often one partner is higher earner, and the other one may not be earning at all, may not be a taxpayer. So then when you're paying dividends, you would probably want to put through as much dividends as possible to the non-taxpayer, because then you can maximize the basic rate band, which allows you to take dividends at 7.5%. So that's great. But if you were a higher rate taxpayer and you paid yourself, all that dividend, that's, we're looking at 38% of dividends. So that's where a mistake often comes, because once you've built up, once a company is worth, a lot more, and then you think, oh, actually, I'm going to, change the classes of shares, or I'm going to perhaps issue more shares. That's when it all becomes a little bit complicated. And if you're wanting to perhaps pass the shares to your children or other members of family, then that is considered as a disposal for tax purposes, and the capital gains tax will be payable. And then obviously we've got the company valuation issues, and it all becomes a much more expensive exercise. Whereas again, this is something at the beginning that could be avoided and planned better. In fact, I was talking to one of my clients last week, and we were discussing just that. And I said to him, I said, well, look, if you are to put the alphabet, that's what we call alphabet shares, in your company, then I know it costs more to set it up. It could cost you around £1,000 to change your to have what's the word, the
To change your articles of association?
that's the one, to change your articles of association. Thank you, Patricia. So it may cost you £1,000 to change that, and you think, oh my goodness, that's a lot of money. But you would save we went through the figures, and I said, by you spending that £1,000 to change the articles of association, you're going to benefit £5,000 in that particular tax year. So it's going not only to pay for itself, that saving, but you're also going to get much more out of that. So when you quantify, and then if you look at the lasting benefit of it, it's remarkable. It really is. And those are the things that people often don't know. These are the things people think they don't need at the beginning. But that beginning becomes, you know how time goes by quickly. 5, 10 years goes like a snap. And before you know it, you've built, a good portfolio, and you're thinking, oh, I want to take that money out. How do I do it? And then you go see your accountant, and they say, well, if you had Alphabet shares, you could do this, and we can change it into Alphabet shares, but it's going to cost you that much. So yeah, that's one of the other mistakes. Um, Let me think if I can possibly think of anything else. Mm, Perhaps you can ask me a question, Patricia, so that
Okay.
to get the conversation rolling.
Okay. And what I'm also going to say to people is, honestly, click on Rosita's face, follow her, go into the rooms where she's talking, because that there's no way that Rosita can distill all of the things, all of the knowledge in the topics that we're talking about here within an hour. Impossible. Absolutely impossible. So, what you're getting is just like snippets of information, which will allow you to think about your circumstances and then just say, oh, I need to do something about it. I need to maybe go and speak to somebody about this. So, that's all that's about. So, do click on her face, do follow her. Do again, her website is pinned above. Click on that. Go talk to her. Talk to her. Get money. My late father, God bless him, always used to say, "Don't be penny wise and pound foolish," and I so love that phrase, and I use it a lot. Honestly, people, please don't be penny wise and pound foolish. Spend a little bit of money to save you a lot more. Just like Rosita was saying with her last client, he spent £1,000 and yet was going to save £5,000. So £4,000 net better off. That is, so the £1,000 really just pales into insignificance. It's nothing, absolutely nothing. So that's that, Rosita. But also now, okay, so yeah, just to kind of like just throw this out there. So so this is me personally. I received some money from a share of freehold that I own. So I own it with some other people, and there are 9 of us, and I think 10 people. Oh, there's a story behind this. I'm not going to go into it. So 10 people extended their leases, and of the 10 people, only 8 of them were freehold owners, and 2 of them weren't. Anyway, I've been paid a nice sum of money in time for Christmas, and how do I treat that? So let me not tell you my understanding about how I treat the money. You tell me, how do I treat that?
So tell me a little bit more. Again, what entity paid you? Was that corporate entity, or was that a
Okay.
partnership?
o-
How
o-
was it?
Okay, so what happened was when we bought the freehold, I actually owned a flat in the block. And then somebody came to me and said, Patricia, we want to buy the freehold. Do you want to join in with us? So I said, oh, yes, please. Sounds good. So this was way back in, I think, 98. Um, and we each paid in, I can't actually remember exactly how much, but it was between like £2,000 and £3,000. Then I sold my flat, but I didn't sell my share of freehold. And then we nearly went to court over that. But in the end, they agreed that I could actually hold on to my share of freehold because I made sure that I did the right things and, kind of like, set it all up for me. And anyway, so I've been receiving like ground rent income since then. So, and I treat that as income tax. I don't have any issues with that. Um, but with this kind of like lease extension business, they've paid me 10,400 is my share of. So there are 24 flats altogether in the block. It's a lovely block of flats in Clapham, and so I've got this 10,400 that they've paid me, and I'm thinking this is a capital sum in my hands now. Do I treat it as a part disposal, which I guess I ought to, because it's 24 flats and we're talking 10, so I guess it will be 10/24ths of the 2,000 whatever it was that I spent to buy it. I'm just going to estimate it because I don't know, I can't remember how much it was. um and then I pay, and then I declare that as capital gains tax, but because I'm not making any other gain in the same tax year, I'm thinking that's going to be, I'll have my annual exemption to offset against it, so I won't have to pay any tax on it. So that is where I'm at on that. Tell me.
So thank you. So then again, going back to what structure was it? How was the deal structured? So your
Sorry.
share in that lease is this a corporate structure? Um,
No,
yeah.
we all just bought in our individual names, and then we had two of us were nominated trustees. So yeah, this is in my personal name, not and the monies have come, if well, they've come from the solicitors acting on behalf
Mm,
of the named trustees, who
yeah.
are trustees for all of us.
So is this something that you do a lot of? And again, so we would have to be looking at the, badges of trade, as you know, Patricia.
Yep,
So we
yep.
need,
No, this is not. It's well, I am freeholder in more than one place, but I
yeah.
I, I don't um, trade in freeholds,
Hmm.
and when I do get the freeholds, they are for investment purposes, and not, unfortunately for me, not too many of them want to, not too many leaseholders want to extend their leases, because I'd be delighted if they all wanted to. So no, I think I'm safely out of the trading realm for this particular receipt. Yeah.
Well, so there you are. So you sort of explained yourself, really, that if you feel comfortable that that's out of the, trading realm, then yes, that would be a capital gains. And like you correctly said, so it will be below the 12,300 annual exemption. And you would have to pay no tax on that, which is amazing. Um, but yes, it's just to make sure, because obviously you are a property investor, and as you know, in land, dealing in buildings and land, is all about the intention. What was the intention purchasing that property? And so this is actually where my passion lies for tax, is that there isn't there's nothing black and white in tax. It's all about the interpretation of law, and it's the view that we take, and it's how we pull various acts together, and how we interpret it all, and how we argue our points. And I'm sure you probably, Patricia, you agree. It's the same with in law with you. It's how you argue your point, because you've got to always think, not of the worst case scenario, but you've got to think, well, actually, if HMRC was to question that, how am I going to be defending this to be a capital gains transaction rather than income transaction? So for me, number one is, I would always look at, I'm just going to digress a little bit. Back in March, I have a dog, and she had a litter of five puppies, and we all know the prices of dogs this year that they were, and so we've sold four of those puppies. And I'll put as a fun post on my Facebook, will I actually have to pay capital gain, sorry, the income tax or any tax on that? What is the situation? So, number one step is you look whether it's an exempt asset. So in property, obviously it isn't, but in my case, it was exempt because it's a livestock basically. And also then you look at the badges of trade, how many transactions, how it's been financed, what is the, yeah, it was the profit motive, the, like I said, frequency, um, the nature of asset. Is there a similar trade? So for you, you see there is, obviously you are involved in a similar trade. What type of finance was used, how long it was held for. So the fact that it was held since 1998 would, be one of the, determining factors of that leaning towards the capital gain. And the way the transaction was carried out, reason for acquisition and sale. So this is where we are talking about the intention. What is it that you were expecting to achieve from that? So yeah, all of these aspects will be looked at and argued, and how many recently similar transactions taking place. What is it that you intend to do in the future? So if it's just a one-off transaction, yes, but the more transactions like that you complete, then those following transactions will taint the initial transactions. And then it could become a case where the first transaction, yes, it was capital gains, but further transactions could be income tax.
Do you know, and thank you, Rosita. And, just for people in the room, I, I didn't just guess my situation because, again, many moons ago, I was also actually a chartered tax advisor.
I
Because,
didn't know that.
oh, did I not? Have I not told you that?
No, no,
Oh
not at
gosh, yeah,
all.
yeah, I was. I went down the indirect tax route, but obviously
Mm.
I still had to do some direct tax stuff. But yeah, I was ATII qualified back in the
Wow.
day. Um, so it kind of like just helps me a bit. Oh, okay, great stuff, wonderful. So we are coming to the end of the room, but Rosita, you've shared with us some amazing, amazing things that people really should be thinking about, in their property businesses. You've spoken about three of them. First of all, is, get proper tax advice, and then that way you can build your business on very, very solid foundations, and that is just amazing. Two is the salary option. Don't give it away. Look at what you can do, through earning a salary, in your company and or companies. And the third one was, look at classes of shares if you are just, forming your company and or you've only recently formed your company. So three amazing tips about mistakes that people make often in property and that we should not be making. So, like I've said to people in the room, please do tap on Rosita's face, please do follow her, please do tap on the link to her website, because again, you can get some more information from there. And, just go ask the question. Ask a question. Rosita's not going to mind. And because if you don't ask, you won't know. You just really will not know. And, Rosita is a very, very kind and sharing person, and she honestly will not mind. Now, in terms of where you can find, this particular discussion, it will be on Clubhouse, as always. It will be under my profile, under Rosita's profile, and under the club profile. So the club is the club which is above. You can see the green Monopoly house right at the top of your screens. Maximising property, pound, pound, pound. They wouldn't let me put values in there anyway. There it is. And if you want to subscribe to the club as well, tap on there and, just join. And it will also be released as a podcast next week. So on Wednesday week, it will be released as a podcast. So if you tap on the link that I've just shared, you might be able to see your favourite listening app. Um, and then just, go there and subscribe to Maximizing Property Values. And there we are. You can listen to it whichever way you choose. So, Rosita, do you have any closing remarks for us before we end the room? I don't want to take up your valuable time, because I know how valuable your time is. And thank you
Thank you,
so much for,
Patricia.
just sharing it with, sharing your experience with us and being here today. I really,
Thank
really appreciate
you.
it.
I'm just so sorry. My dog is barking, and I think I've got the UPS delivery, the driver at the door actually coming to collect the parcel. So I'll be very quick. One thing that you didn't mention in the summary is the saving of the paying the director's interest on a director's loan account. But I just really wanted to say thank you so much. What got me into tax is the desire to help individuals and business owners to save tax. Because when I was married, my husband, ex-husband, he ran a very profitable business, and we struggled to find the ways of saving the money. And that's what really inspired me to get into it. And yeah, and help everybody and ourselves. So yeah, that's my passion, and I'm sharing that with the world. And I'm really hoping to bring so much more to everybody in the years to come, as my confidence grows, as my experience expands, and as my network also grows. So it's just I'm really lucky to be able to actually do the job that I absolutely love, and that I help people. And when my clients have tears in their eyes and they say, "Thank you so much. I'm so glad I found you," then I know I'm living my purpose, and I'm just really overjoyed. So thank you so much, Patricia. I'm really grateful for your time and everybody who was here in this room, and for this opportunity to spread the message and my passion.
Oh, thank you, thank you, thank you, thank you. So yeah, honestly, thank you for doing this with me. And next week, people, we've got Anjuela Ismaili. Now, Anjuela will talk about how she invests in Albania. She's actually from Albania, but she will kind of like be talking about some opportunities if people are that way inclined. But also, it's very good to listen to somebody who's building up a property business as well as starting a family. She has a really, really young baby, so no doubt we're going to talk about her. And in the meantime, everyone, have a great Christmas, and hopefully see you next week on Wednesday. And once more, thank you very much, Rosita.
Thank you, Patricia. Really appreciate that.